Okay, guys, a little different scenery today. I want to show you something different. Today we're here in upstate New York. We're up here in the Great Sacandaga Lake. For those of you who don't know where that is, we're about 30 minutes west of Saratoga Springs, New York. Beautiful July day here in upstate New York. 75 and sunny, man. All you people down in Florida watching me eat your heart out. Anyways, hey guys, my name is Jim Montrym. Many of you know me as your mortgage instructor for the pre-licensed 20-hour required national course. And also continuing ed. We're getting into that season right now, guys. And, you know, again, I'm the guy to go to. If you need to get the education, guys, I would appreciate being your vendor. Spread me around. This blog, trust me, I'm getting literally thousands of responses to this blog. And it's because you guys are sending it out. Now, here's the way I do this, guys. I teach you some material for about 8 to 10 minutes. And at the end, I'll be asking you a question. And if you email me back with the answer, I'll enter you to a drawing for free continuing ed. I'm going to give away about a dozen courses here in October. Give a shot. Just answer the question. Send it back. All right? So anyways, guys, today, first thing I want to talk to you about, okay? Again, you know me, big regulation guy with the federal government. Now, here's something that's a little scary, okay? Makes me a little nervous. Now, we all know I've talked many times in this blog about the Consumer Financial Protection Bureau. All right? Remember what I tell you before. These guys, the difference between CFPB and formerly the state of Florida and state regulators is when CFPB was formed, what was it? Elizabeth Warren said, we're going to be the cop on the beat. In other words, instead of just reacting to consumer complaints, we're out there looking for problems and looking to make examples. Well, here's a good one, guys. Scares the heck out of me. Many of you have heard of a big finance company called PHH, okay? They got in trouble, and here's why. They were basically at their financing, doing the mortgages, referring the borrowers to a certain PMI company. And it turns out PHH actually owned that PMI company. We're getting money back, basically kickbacks. Okay, well, here's the deal. They got brought up on charges, okay? An administrative law recommended a $6.5 million fine. That's a lot of money to most of us, but to these guys, relatively not a lot. Well, here's the really scary part. Richard Cordray and the Consumer Financial Protection Bureau said, no, we're not going to go with what the judge, an administrative law judge, recommended. We're going to go for a number, get this, it's going to be $109 million, 16 times more than what the judge recommended, guys. That's unheard of. Normally in these things, administratively, they always go with what the judge says. But that's CFPB, guys. So, again, guys, kind of scary, all right? Remember that, because, again, guys, is CFPB above a judge in a court of law? I don't know, but they sure think they are, all right? So, anyways, guys, remember, now, again, RESPA, just refresh your memory, guys. Now, they changed this a couple years ago. Now, RESPA, basically, borrowers have 3 years to come after you for a civil violation, all right? And also, now, the government has a 3-year statute of limitation on criminal. So again, when you're referring people and you're doing the quid quo pro thing, you know, something for something, even exchange, this kind of stuff can happen. So a little scary, okay? But bring you up to date on that. Okay, guys, segment number 2 I want to talk about. Okay, now, they're just starting the Federal Housing Finance Authority. Again, let's refresh. Who's FHFA? Who are they? That's Fannie Mae and Freddie Mac's boss, all right, Mel Watt. He's in charge of that government agency. And they are in the process of deciding right now, are they going to raise jumbo loan limits? Most parts of the country, jumbo limits, biggest loan you can sell to Fannie Mae or Freddie Mac, $417,000. Some high-cost areas out there. But they're kicking the idea around right now of raising that limit. It's been at 417, I believe, since about 2006. I'm almost shocked it didn't go down in the market downpour. But again, they're right now in the process of looking at it. Really, some people have said to me, Jim, what's the big deal? Because it used to be years ago when you got above that current Fannie or Freddie limit, you'd pay a 0.5% higher rate. Well, that's not today's case. Today's case, a lot of the banks are really targeting, you know, the higher net worth people, because, you know, those are the people that are getting those larger mortgages, and really the rates have almost become about the same. So it's probably not as a big deal as it used to be, because like I said, the rates are pretty comparable when they get above that, and a lot of these lenders are following that. But it's on the burner. Look for that change. If it happens, guys, January 1 of 2016, loan limit changes, okay? Just a couple more quick ones. Not trying to beat you up today. Just want you to enjoy the beautiful scenery. Really what I wanted to do. Okay, let's talk about this one. Okay, basically today, guys, the mean sales price. Mean means the average of all sales in America. You ready for this? $236,000. That's up. That's 04 prices, basically, guys. We're back to the 04 sales level. Another thing I think I'll throw out, I found this interesting. They say today, in the month of June, this year, 2015, there were over 4 million people that began their search looking for a mortgage, basically went to the internet, okay? Basically, they say 90% of people that are thinking about obtaining a home mortgage do go first to the internet. But here's the crazy part, guys. Remember this part. 51% of all mortgages, why are they done? A referral from someone else, typically a realtor, a builder, obviously a family friend, those kind of things. So again, and I think, guys, going next year, we all know that rates are probably going to be increased by the Fed come the end of this year. So the refi boom is going to be kind of winding down. I think next year, it's pretty much in the leaves. Next year is going to be more going after the purchase business, the realtor, the builder. Probably want to be shifting your gears next year for that one. And then finally, guys, one last thing I'm going to throw in here. I think it'll be pretty interesting, okay? I've been telling you that the subprime, non-qualified mortgage bear is starting to come out of the cave. Yeah, a company called United Wholesale of Michigan. Saw some interesting products they're offering. Here it is, guys. They're offering, number one, an interest-only mortgage. Remember, interest-only under qualified mortgage rules, big no-no. Can't do it. Doesn't fit the qualified mortgage model. But this company, United Wholesale of Michigan, I like this program, they would require a 20% down payment for interest only. You have to have a minimum FICO of 720, all right? And then also, if you choose an adjustable rate product, okay, you have to be able to pay the fully indexed rate. In other words, guys, the highest rate you could pay possibly, all right? That's why, frankly, today the 5-1 ARM is sort of out there. We don't see it ARM rate. Most people haven't went ARMs, but that ARM that's set for 5, and then it goes to a adjustable product year number 6. But again, this company's saying if we take that option, that product, that interest only, we're going to do the fully indexed rate, not the teaser rate we start you at, but what's the highest rate? Could you afford that payment when we make the loan? Okay, guys. Again, want to say thank you guys for watching the blog. We're getting into continuing ed. I just sent out a postcard to a lot of you guys, so if you got it, there's a little discount on there. I'll be glad to give it to anybody else you have in your company. All right, so I want to say again, thank you for watching the class, okay? And the last thing I want to ask you guys, here's the quiz question. This is the one that gets you the free CE if I pick your name in October, all right? That fine that was levied against PHH Mortgage Company, all right, how much did they increase it? Okay, it started at $6.5 million. That was what the judge recommended. What did Richard Cordray and the CFPB, their recommendation is? How much is it? Okay, answer that question back to the website and to the email down below, and I'll enter you. Okay, guys? And once again, please send me around, guys. If you can do that, that's the greatest compliment you can get. So you hang in there, and I'm going to see you. Again, remember, we don't look at your past. We credit your future. Yeah. See you next time. Bye.